Good day, Dean Orrico with Middlefield. I'm really happy to be joined today by Michael Cooper, founder of the Dream Group of Companies as President and Chief Responsible Officer, a group he started in the mid-90s and today is really involved in virtually every aspect of the real estate industry throughout Canada, Europe, the US, and with a wealth of knowledge that I think we can learn from. And a few of the vehicles I want to focus on today, Michael, beginning with Dream Industrial REIT. It's a company we own across our Middlefield portfolios. And it was about a year ago you announced that you were acquiring, together with GIC from Singapore, Summit REIT, which is one of the largest industrial REITs in Canada, major presence in the Toronto market. Just briefly, how's that deal gone? Have you learned anything new from, or maybe a surprise in that acquisition?
Well, that's a great question. Firstly, thank you for having me. Specifically on that transaction, it's tracking very, very well to the underwriting. And, have I learned anything? Not really. Other than the fact that across Canada, industrial's in very good shape. And we did better on a lot of the rollovers, meaning the market rent went up higher than we had projected. But I think overall what we're seeing is throughout the country, industrial's in great shape. We're also developing buildings. They're doing well. The rents aren't increasing as much as they were before because that was stratospheric. But the other side of that is Alberta is starting to contribute more because the rents there are starting to catch up. So overall, it's been great.
Michael, there's been lots of discussion in the market about private versus public valuations. We know the public REITs, and DIR in particular, we believe it's trading at a substantial discount to what the business is worth. We've seen private valuations really hold in. Is there a right or a wrong here in terms of how they're valuing your assets versus, what the market is saying?
I think what's happened in the private markets is a year goes by, rents go up, and cap rates can go up. But when you take a look at the absolute value for a building, if it was $10 million last year, it's probably about $10 million this year. But if it was a 4 cap last year, it might be a 4.5 cap this year. So it's working pretty well. And I think buyers generally are being selective, but there's a functioning market. In the stock market, I think what's been happening a little bit is with interest rates going up so much, some people are saying, well, I can get 5% from the government. Maybe I won't own a stock. So I think the stocks are not doing as well now as their intrinsic value because of alternative choices for the investor.
And I guess the re-rating or potential re-rating for the publics, is that then contingent on some of these alternatives coming down in yield and making the REITs more attractive again?
It could. I think some of it may just be this rotation and getting to an equilibrium where people start to say, oh, well, these businesses are doing pretty good. On the margin, I'll put more money into the stock market. So I think it's an adjustment. For those buildings that have for those businesses that have pricing power, particularly industrial and apartments, I think that the gap will narrow.
And that brings me to my next question. When we think about Dream Industrial, great portfolio of industrial assets throughout Canada, the US, Europe. We've seen the distribution basically kind of hold in at about 70 cents for a number of years now, even though your payout ratio is getting better, your asset quality, as I say, is getting better. How do you think about the distribution, especially in light of there is an alternative out there that we call GICs?
It's a great question, and it's great because it's more relevant now than it would have been before. For a long time, internationally, people felt that the payout ratios in Canada were too high. So across the board, Canadian REITs were trying to reduce the payout ratio and not raise the dividend as much. But as you mentioned, because the alternative that's risk-free is a higher yield, we may see REITs raising their dividend a bit more, particularly with Dream Industrial REIT. This is something we talk about, but I would say generally we've been driving down the payout ratio. But it's something I think it's a good idea. I think we should talk about at the board. Our board is probably kind of indifferent between a higher payout ratio or a lower payout ratio and more focused on we want to do what's best for the company.
Let's switch gears here and talk about apartments and residential. You've got another vehicle, Dream Residential, which you IPO'd about 18 months ago, primarily in the US, where its exposure is. We know this is a pretty hot market in Canada. You've seen some supply come on in the US. How are you looking at Dream Residential these days in terms of its ability to grow in light of a higher cost of capital?
They're all great questions. We went public 18 months ago. It was tough to do an IPO. I think it was the only IPO in Canada that year, and there hasn't been a real estate IPO this year that I know of. So we got through, and that was great because there's about 7 different transactions to put all the assets together, and we want to get that done. The business has performed starkingly, as we said, and the rents have been good. We've been turning over suites, improving them. So the business is good. It's got about 25% debt, so it's very secure. The debt goes to 2027 or 2028, so nothing much has changed from what we had expected, but it's a small REIT, which is not attractive in this market, meaning the small REITs may have a bigger discount than the high-quality REITs, which also have a discount but not as big. But we're starting to see opportunities now to, without issuing equity, create, maybe bring in other investors on the private side and start to build that business. So we're really quite excited about the business, and we haven't seen anything that concerns us on the operating level.
And staying with residential and more focused on Canada, as you've acknowledged, we've got a housing crisis in this country. We've got much more demand than we have supply. We've recently seen governments, provincial and federal, say, you're not going to pay any HST on purpose-built rental. In your view, is that going to move the dial? And how do you think we address this shortage of housing in this country?
The HST reduces the cost of an apartment building in Ontario by about 7%. And that's meaningful. That's not cutting back costs. You get the same building at 7% less. That makes it easier to build. I think we're going to find that, and that was September 18th that was announced. Since then, the 10-year bond has gone up about 60 basis points. And that makes it almost the same economics as when you had to pay HST on September 18th. It's a big deal, but the increase in debt has really hurt. As a result, we think the government's going to have to do more because we have so many people coming to Canada. We have people moving into the bigger cities from within Canada, and we don't have enough housing. So it's going to be a crisis. Not like it feels like it's hard to rent. It's going to be much worse unless we build a lot more. So I think private sector plus governments will probably figure out a way to open up the spigot to build a lot more.
Let's switch gears here a little bit and talk about office. You've got Dream Office, which is a major landlord of office properties in Canada. This has been a sector that's really evolved quite a bit, through the pandemic, and this whole discussion about work from home and all the issues that go along with that. As a general point, how is this affecting the office market, and how do you think this is going to evolve over the next few years?
It is a situation I have never seen before in office or anywhere else in any sector, and it's very difficult to know where it gets to. It's been problematic, and I think it means that there's some older builders going to have a real difficult time attracting tenants. But people also want new space, so there will be some new buildings built. I think office space, the demand will start to pick up again. Ironically, I think right now what we're seeing is some of the big users of space, like the banks, are reducing the amount of space they're using. On the hybrid work front, I think we'll get more people back in the office, but I think we have a reasonable amount on, let's say, Tuesday, Wednesday, Thursday. I also think that we got to too little space, and we need more amenities in the space. People want to congregate and have, we need a lot of meeting rooms. We want to have some big spaces for the whole company. So I think we're going to see an equilibrium come. That may not be as high occupancy as we had in 2019, but higher than where it is now. And I think maybe the cost to attract a tenant will not be as low as it was in 2019, but not where it is now. And when we get there, I think that there'll be a lot more information to value office buildings. But right now, office buildings are unloved.
And we can look at office buildings from a very broad perspective, but when you look below the surface, we know there's some older office buildings, call them B and C buildings. There's been lots of discussion about potentially repurposing those buildings because we have a shortage of housing. We've got B and C buildings in the office sector nobody wants. How do you think that evolves?
We're Toronto-centric. Over 80% of our office buildings are in Toronto. In Toronto, you have to replace the office space. If you tear down an office building, you have to replace it. In Calgary,
with a new office building.
That office space. In Calgary, They want to see the office building become residential, and they'll give you a financial incentive. So I think Toronto is being very thoughtful about it. I think everybody knows we're going to get to a point where there's no reason to preserve office space out of principle, and we definitely need housing. So that's coming, and I think that'll be very good because it'll reduce the excess supply of office, and it will increase the provision of apartments. So that'll be great.
And with respect to residential in places like the GTA, where we've seen lots of condo development, and you probably have a better feel for this than I do, 50, 70% of condos go into the rental market. Is that going to continue to be a solution, or do you need a lot more purpose-built rental?
I think that condos, it wasn't intended this way, but in order to get your pre-sales, to get your financing, investors bought them. And investors bought them to rent out to other people. So you had all these small landlords who were actually being very helpful to create the new supply. Later on, it became apparent maybe that institutions could get a decent return doing purpose-built rental. Maybe 10 or 12 years ago that started. So that's the whole building. That's carried on. I think the advantage about purpose-built rental is it's always going to be in the rental stock, and it's professionally managed. You don't get kicked out because somebody says, I want to live there, which you're allowed to do. You can ask somebody to leave so you can use it. So I think there's a benefit of professional rental, and I think we're going to see a lot more of it.
Last question. We know real estate industry really does make more, it becomes economic because you can get access to financing, which we know is tougher. Rates are higher. What are you seeing in the debt markets up here in Canada? Because we see lots of news about Brookfield in LA giving the keys back on an office building. Is that happening in the Canadian market? Is it different?
We're very fortunate in Canada to have a very strong banking system. And we saw that in 2008, and we're seeing it again. So generally, in Canada, the banks are working with owners to renew leases. Banks don't want to take back assets. So there's in the States, they give back assets. Those are non-recourse. In Canada, it's recourse. We lend a lower amount. So it's pretty strong, and the banks have been there. Around the edges, maybe some buildings, they want a little bit more of a pay down. Maybe some borrowers aren't in a strong position. They want them to pay down. But for the most part in Canada, people are getting the debt they would expect.
Well, it's good to hear. Well, thank you, Michael. Appreciate your insights, and keep up the great work at your various dream businesses. We're big owners and happy owners. Thank you.
Thank you for having me, and best wishes to everybody listening.